As a beginner investor, well, first off, welcome. That's fantastic that you are saving money and you want to grow that money in the world of investing. So well done to you. But in that world, if you're not careful, you can get yourself taken advantage of very, very quickly. And at the core, what I want to focus on here is drawing a line. What are we drawing a line to separate? Incentive levels, because incentive levels can get blurred very quickly. And if you allow that to happen, then you open yourself up to getting taken advantage of as an investor. And yeah, we want to avoid that. This whole video comes from a comment I got, and within the comment, you can see this person is a kind human being. They are compassionate, they want to help, they're forgiving, and that stuff is great in the real world. But when it comes to investing, no, unacceptable. You can't be that way. You have to be in line with your own incentives. So let's get to this comment and start to break it down. You have to remember that AMC is not a profitable company and has consistently been burning cash.
Whoopsie daisy!
A little context, I did a video recently on AMC and how things were just not going well and all of that, and this person replied saying, well, hey, they're not profitable and they have been burning cash. So let's keep on moving. The capital raises have been the only thing that have allowed AMC to survive for this long. And I mean, what is a capital raise?
Money, please. My money.
Literally just money being handed over to the company by additional shares, meaning they're offering more shares to the market to raise that money. So it's literally just, hey, give me more money. And this person's saying, hey, that's what's been allowing this to go on. This is what's allowed AMC to continue to survive, are these capital raises. Who are capital raises to? Well, the general public, or in other words, the common shareholders. But let's finish this out and see how they kind of rationalize this. Again, very, very kind person. Their heart's in the right spot, but we don't want hearts when it comes to investing. I hate dilution, but in this case, it is necessary to avoid bankruptcy.
Oh boy.
Now, all of what has been said is true. So this person's not wrong, they just have their incentive levels mixed up. So what is this line that needs to be drawn? Well, we are drawing a line between the company and the common shareholder. Keyword being common shareholder, not bondholders, not preferred shareholders, common shareholders. So when you go and buy stock at Robinhood or Webull or Charles Schwab or whoever your broker is, you are buying common stock. Therefore, you are a common shareholder. So once again, we have common shareholders line the company. Now the company, yes, they want to serve their shareholders, but you are down at the lowest part of the totem pole. And when the company does what it needs to do to survive, well, yes, the company in this category, it is surviving, but at what cost? That is the key question. At what cost? What is it doing to accomplish this? Well, that's where the capital raises come into play. That's where the dilution comes into play. Dilution just means that your shares are worth less because there are more of them. And that is what's occurring in this category over here. So in other words, the company in this category is reaching over into the category that you're in and essentially slaughtering you. They are slaughtering the common shareholder in order to protect the company, in order to allow the company to survive. So sure, in this category, the company is surviving, but you as a shareholder in this category, you are getting slaughtered. Your shares are losing value. Your shares are potentially going to zero and then they reverse split. And I won't go down that rabbit hole, but that is just a bad thing for a common shareholder. You don't want reverse splits. But if you're sitting here just saying, well, this is for the good of the company. You're right, it is for the good of the company. Different category. But when you are the one being used, when you're the one being slaughtered to benefit the company, well, then that doesn't benefit you. Your incentive is off. The incentive of the company is to survive. The incentive of the shareholder is to make money. But when the company is slaughtering you by diluting you, you are not making money, but the company is surviving. Do you see why these things need to be separated out with that line? And let's take a look at another example. Now, this company has been struggling, but check it out. This price went from here all the way up to here. So this big old price movement happened, and then what did the company do? GameStop, shares fall 20%. Why would they fall 20%? After it files to sell additional stock. So again, another struggling company, what happens? Share price goes up. Who is that good for? Well, that's good for both categories. It's certainly good for the common shareholder category, but then what does the company do all of a sudden? The company that is struggling. Let's register more stock. Let's register it. Let's get some more stock out there to sell. In other words, to dilute. A capital raise. Now, that is the nice thing about public companies is they do have to announce this stuff. They can't just randomly do it. So you are going to have a heads up, and that's what you need to pay attention to. But don't look at this stuff and say, well, it's a capital raise. That's going to help the company to survive. Yeah, the company survive. Your investment portfolio might be going to zero at the same time. So that's what you ultimately need to remember is at the core, setting everything else aside. There is a world where it's possible for a company to survive, but your investment portfolio to go to zero. I want to say that one more time. It is 100% possible, which is what's going on with the examples you saw here. For a company in this category to survive, while in this category, your investment in that company goes to zero. I understand as a beginner that may not make a whole lot of sense, but the more you dig, the more you'll see how this works. But again, you've got to draw the line. Where are the incentives at? The company, the common shareholder. Now for good quality companies, they're both in alignment. Common shareholders are making money. The company's doing great. But when companies really start to struggle, very, very bad trap to fall into again, a noble mindset, a very compassionate, forgiving mindset of, it's okay. We're going to help you survive. No, you're not. You're not going to survive. They're going to survive. Hence, you got to draw that line. So I hope this helps. If there's any questions or anything like that, leave those down below. But remember, you got to understand incentive levels. You got to draw that line as a beginner investor. And as soon as you realize that, you're going to set up a shield of getting taken advantage of. Because these companies will gladly take advantage of people's willingness to just sit there and get diluted. And you just don't want that in terms of having a successful long-term investment strategy. So like I said, I hope this helps. Leave any comments down below. First off, thanks so much for watching the entire video. Real quick, before you go, I want to invite you to a live webinar, web class, training, workshop, online event, whatever you want to call it, but it will be me live revealing to you what I've discovered that has allowed me to transform myself from being an employee to being my own boss, including how I had only one losing day out of 73 days in total. I'm going to cover 3 keys that have helped me unlock profitable consistency within the markets. The first key is super weird, but in a productive type of way. The second key is super awesome because it quite literally is wired into our DNA as humans, making it very easy to use. But in a cruel way, this becomes a pitfall for many traders. I'll explain it all though, including how to avoid the pitfall that it creates for some. And the third key, when you hear it, sounds way too good to be true, but it's not, and I'll show you how it all works. Then at the end, I open it up for a question and answer session that is, again, totally live. Even if you can't make the live session, please still sign up as it will be recorded, and you can go back and watch the replay that I will send you. Click the image on the screen or click the link down in the description box so you can get the date and time and claim your spot, which I should note is limited due to the fact that this truly is a live event. If you have any questions, let me know. If not, I'll be seeing you soon.